Tom Lee, head of research at Fundstrat, sat down on CNBC's Squawk Box recently to debate whether the massive capital flowing into artificial intelligence is a structural goldmine or a brewing financial disaster. By the end of this video breakdown, you will know exactly why the historical comparison to legendary infrastructure booms remains the ultimate battleground for investors, trying to determine if this market is a genuine transformation or a dangerous bubble. I'll show you the clip of Tom Lee on CNBC uninterrupted, and after that, I'll give you my own reaction breakdown to what he said.
I was a tech analyst during the dot-com and fiber boom of the 90s, and the people investing capital at that time were not of the same ilk and caliber of the Mag 7. You know, these were companies that were digging up railroad lines and doing those IRUs, you know, which was actually...
What's an IRU?
It was a revenue swap between fiber companies. So you could create hundreds of billions of dollars of contractual revenue. And today we have companies with really sizable moats and some of the highest profit margins and return on capital in history, and have, as the Bezos metric, have delivered trillions of dollars of shareholder return that are now directing their investment on building a new moat around AI. So I have a lot more confidence that these are high-level board, well-reasoned companies investing, but they're eye-popping numbers. But the reality
Why not do it on balance sheet?
Well, one, they could do it on balance sheet, but if they did, they would be taking up all the capital of the world and all the risk, and therefore actually make it harder for any. I would argue that that would make it harder to democratize AI.
Can I ask an accounting question? We were calling this off. I did get a C in accounting. I got a C, so I need to ask all of you to make sure I'm understanding this. They have off-balance sheet commitments because they're future commitments. Is that right? They're not hiding anything.
Yes.
They're not on the balance sheet because they don't flow through the balance sheet until the building actually begins. So in other words, this is just a different way to look at, if they say, okay, we're going to spend whatever amount in 2027. Can you explain to me exactly what these commitments are and why they're not on the balance sheet and when they will be?
Yeah. Well, I think maybe a good place to start is I think that the revelations from the journal article are actually helpful, but they're giving people an incomplete picture of how financial systems work. Because if you do, the gross obligations of the financial system, it's multiple times the underlying assets.
Always or just today?
Always. In fact, that's why Warren Buffett used to call credit derivatives, the weapons of mass destruction.
Are these credit derivatives that we're talking about, though, or these are just future spend commitments?
It's the same. Arguably, it's not that different. Because if you did, gross exposure of swaps or options, look at in any day, options contracts are multiples of cash underlying. So if someone says, oh, there's a hidden off-balance sheet risk that retail investors have 20 times the size of the stock market in bets, we'd be like, well, there's the offset. So I would say when we look at these numbers, it's giving a distorted view of the actual risk.
Let me just press this analogy one more. In other words, do you think that the spending is representing multiple possibilities of spend that's only going to manifest in one way?
I think, to me, none of these contracts are going to lead to criminal liability. In other words, a company can decide to cut spending in the future, and the contract should be weak. So, the $3 trillion isn't people have to sign over their kidneys to meet.
And Dryden, how should investors think about this? I mean, should they be worried, or should they be encouraged that, wow, it's not just $600 billion, it's actually an additional, 1.4 or up to $3 trillion, and so therefore that's a good sign about the future of AI. How should investors interpret all of this?
I think it's a good sign because companies are making a lot of money, free cash flow. And what were they doing before? They were buying back their own stock. They didn't have anywhere to go with the money that they were making. And so I like it when someone's, no, I'm not going to buy back my stock because I'm going to actually put it into the thing that I do best, which is grow and do these things. So I like that the capital is being redeployed into what these companies do, because that's their core business. They're not hedge funds. They need to be out there putting their money to work in what they do. So as a growth investor, I like it. I like CFOs and I like CEOs and I like boards going this is our fastball. We're Microsoft.
And you talked about the productivity litmus test. A lot of this, particularly the bonds, are based on revenue expectations in 2 to 3 years. that are ginormous compared to what they are today. Do you think we get there based on what you're seeing?
56% of the companies today have an AI account. But only about 30% of them 30% of them say, hey, I'm seeing increased labor productivity, and only 7% say we fully implemented. So you have all of these companies that have yet to play. You have all these companies that are just now scratching the surface. We're moving from infrastructure to implementation. We're moving from proof of concept to rapid adoption. And this is an area of time where we think, margins are good. The wide moats are getting wider.
You think that can happen without a dramatic rise in unemployment?
Yeah.
That those productivity gains, because productivity gains come in some ways by replacing workers with AI.
Well, this is true, but you've seen this every time. I mean,
right.
People got upset. The guys who were shoeing horses got upset when the Model T came out.
Right.
But next thing you know, they got a perfectly good job working in the factory, and they were making more money when it was over with. So I think that we see this transition, but I think it's positive. It's Jevons paradox. And
so it's a J curve. You don't see the bottom of that J curve being too severe.
No, I don't. And we only need about 30 to 40,000 jobs a month to maintain our unemployment rate now anyway. So the break-even point is less.
Yeah.
The adoption's more. Labor productivity is greater, and that increases profit margins.
I'll end by I'll just throw another major concern on the table. I mean, why not? Tom, $40 trillion in the national debt last night. What is your reaction to or take on that?
I mean, it's pretty shocking that we're in a booming economy and the deficit's growing.
Missiles are expensive.
Yeah.
Interest is expensive.
Yeah.
Yes.
Yeah. It seems like there's a lot of outflows. I agree with the folks who think that this is a structural concern, but the bond market today is signaling that it's completely okay with it. So I think as long as it's okay with it, the stock market is fine.
So that little blip in the 30-year, we saw those the deficit's suddenly an issue that we saw last week with that sale. You don't think that was really a big move, or that's going to continue?
Yeah, I mean, it is a symbolic rate because, as you know, maybe more companies are dependent on the spread to the 10-year.
Right.
So that's the more important rate to watch. But again, I don't think it makes any sense to not be fiscally sound as a nation. So it is
Except
trouble.
It's hard. It's really hard to figure out.
Yeah.
What's amazing is that 10-year range has been so tight for so long. Right. And everything tells you that should be higher, but it's.
Here's the crazy part. It was sub 4. I'm stealing Rick's lines from his mouth. We were below 4% on the 10-year right before the Iran war broke out, and oil prices but now the oil price is back down, and the 10-year is at 471.
Right. And you could argue oil should be higher today and everything else, but it's not.
Yeah. Dryden, a quick final thought.
Well, the short answer is oil in the 80s, we're fine. At low 80s, we're fine. The economy works fine. And then if you get down into the 70s, we get to $3 gas again. So I think that at some point this resolves. Look, economics beats politics every time.
I don't know about that.
And sooner or later, we're going to be able to be in a situation where we'll have better economics.
Dryden, I want to believe you. I will hope to believe you. Tom, thanks so much for joining us, guys. We appreciate it.
To understand why this market structure is so fiercely debated, we have to look at the moment Joe Kernan stopped Tom Lee in his tracks to challenge him on market concentration. Kernan raised a point that has been keeping asset managers awake at night: the fact that a tiny handful of massive technology companies is responsible for the vast majority of the index's gains. The core of his concern was simple and intuitive. If you have an index where the top heavyweights are carrying the entire load, any stumble from those giants will drag the entire market down with them, regardless of how healthy the other 490 companies might be. He pressed Lee on whether this extreme divergence was a structural warning sign that the entire rally was built on a fragile, hollow foundation. Lee did not push back on the concentration itself, but rather on what that concentration actually represents. His argument to Kernan was that this top-heavy structure is not a speculative illusion, but a direct reflection of unprecedented corporate earnings power. To back this up, he pointed out that while the headline index is dominated by megacaps, the equal weight market has quietly been making its own steady progress. This is an important distinction because an equal weight index treats every company the same, meaning a gain in a mid-sized industrial company has the same impact as a gain in a trillion-dollar tech giant. Lee used this data to argue that the market's internal health is actually far more robust than the critics suggest, and that we are seeing a gradual, healthy broadening of the rally rather than a narrowing bubble. My take on this concentration debate is that we have to look past the superficial comparison to past market peaks. When people see a few stocks dominating the index, their minds immediately drift back to the peak of the dot-com boom in 1999. But if you look at the fundamental metrics, that comparison falls apart. In the late 90s, the companies leading the market were trading at price-to-earnings multiples that were purely speculative, often exceeding 70 or 80 times trailing earnings, while producing very little actual free cash flow. Today, the mega-cap tech giants are trading at multiples that are certainly premium, but they are backed by massive, highly defensive cash flows and net income margins that are the envy of the corporate world. They are essentially operating as high-yielding utility companies for the modern digital age. Where I would push back on Lee's optimism, however, is that this concentration does create a unique passive flow risk. Because so much retail and institutional capital is allocated through passive index funds, every dollar that enters the market is mechanically forced to buy more of the largest companies, driving their valuations higher regardless of active analysis. This creates a self-reinforcing loop on the way up, but it also means that if passive flows ever turn negative, the forced selling on the largest weights could be exceptionally intense. That transition in the conversation led naturally to the next major point of friction, where Becky Quick stepped in to challenge Lee on the physical reality of this technology spend. She raised the multi-billion-dollar question: how long can these massive hyperscalers keep spending capital at this current rate before their shareholders demand a tangible return on investment? She pointed out that building data centers and buying advanced silicon is an incredibly capital-intensive endeavor, and if companies like Microsoft or Meta decide to trim their capital expenditure budgets even slightly to protect their margins, the entire semiconductor supply chain will suffer a brutal shock. Lee's response to Quick was to frame the current spending boom not as a temporary fad, but as a modern-day corporate prisoner's dilemma. In his view, no major technology company can afford to slow down its capital expenditures right now because the competitive stakes are simply too high. If a chief executive officer decides to cut their AI infrastructure budget to please short-term shareholders, they risk falling permanently behind their competitors in software capability and operational efficiency. Once you lose that technological edge in a platform shift this massive, it is incredibly difficult to ever win it back. Therefore, Lee argued that the spending will continue because the cost of stopping is far greater than the cost of continuing. The primary beneficiary of this massive spending wave is the company at the very center of the Silicon Rush, and that is Nvidia, ticker symbol NVDA. During the exchange, the hosts and Lee touched on how this specific company has essentially become the gatekeeper of the modern computing transition. With gross margins sitting near 80%, Nvidia is captured in a perfect storm of soaring demand and limited advanced packaging capacity. Lee argued to the panel that we are still in the very early stages of this infrastructure cycle, comparing it to the build-out of the physical internet backbone in the late 90s. My take on this infrastructure spending boom is that we are witnessing a classic hardware-first transition. Historically, whenever a major technological shift occurs, whether it is the transcontinental railroad, the electrical grid, or the fiber optic network, the hardware must be laid down years before the killer software applications are fully developed and monetized. During the late 90s fiber build-out, critics argued that the world would never need that much bandwidth, and the oversupply eventually led to a painful market correction. Yet, that very same underpriced fiber optic network is what paved the way for the creation of the modern mobile web, streaming video, and cloud computing a decade later. The critical difference today is that the companies funding this build-out are not speculative startups borrowing at double-digit interest rates. They are the most profitable enterprises in human history, funding these massive capital expenditures entirely out of their own free cash flow. What I would watch closely, however, is the timeline for software monetization. If we do not start seeing highly profitable, consumer-facing artificial intelligence applications emerge over the next 18 months, institutional investors will eventually lose patience. And even the most ambitious executive teams will be forced to scale back their capital budgets, exposing the semiconductor hardware supply chain to a very sharp cyclical correction. If that changed how you were thinking about this, that's worth a like, and it's worth subscribing to the channel for. The discussion then shifted toward the macroeconomic backdrop, where Andrew Ross Sorkin pressed Lee on how these elevated equity valuations can possibly survive if the Federal Reserve is forced to keep interest rates higher for longer. Sorkin pointed out that the market had spent the previous 12 months pricing in a series of aggressive rate cuts, assuming that inflation would quickly glide back down to the central bank's 2% target. But with services inflation remaining sticky and employment data showing surprising resilience, Sorkin asked how the market could sustain a 20 times forward earnings multiple without the support of cheaper capital. Lee offered Sorkin a fascinating counterintuitive argument that directly challenges traditional economic dogma. He suggested that the market is focusing far too much on nominal borrowing costs and completely overlooking a structural shift in economic productivity. In his view, the rapid adoption of artificial intelligence, robotic process automation, and cloud-based efficiency tools is initiating a massive productivity boom across the private sector. When productivity increases, businesses can produce significantly more output with the same or fewer inputs, which is naturally disinflationary. This means that instead of relying on the Fed to cool the economy through demand destruction, the supply side of the economy is expanding to meet demand more efficiently. Under this scenario, Lee argued that corporate profit margins can continue to expand even in a high-rate environment, allowing the stock market to climb higher without needing aggressive monetary easing. This productivity argument is incredibly compelling, but where I would add some necessary caution is on the historical timeline of these transitions. Productivity booms are very real, but they are notoriously slow to manifest in official macroeconomic data. If we look back at the personal computer revolution, the technology was widely adopted in offices across the globe by the mid to late 80s. Yet it took nearly a decade for those investments to show up as a measurable surge in national productivity statistics between 1995 and 2000. We are expecting a similar miracle to happen in quarters rather than years. My take is that while artificial intelligence will undoubtedly drive massive long-term efficiencies, the near-term transition will be highly uneven. High interest rates act as a heavy, continuous tax on small and mid-sized businesses that rely on floating-rate bank loans and do not have access to the public bond markets. While the cash-rich technology giants are virtually immune to high rates and are actually generating significant interest income on their cash piles, the average business in the S&P 500 is feeling the squeeze. If borrowing costs remain elevated for another year, we could see a widening gap between the highly profitable elite and the highly leveraged rest of the economy, making the broader system much more fragile than the headline stock index indicates. This potential economic fragility led Joe Kernan to double down on the immediate tactical risks, turning the panel's attention to retail investor sentiment and the return of systemic leverage. Kernan asked Lee if we were beginning to see the classic signs of a speculative blow-off top, pointing to the resurgence of speculative activity in retail options trading, high beta momentum stocks, and public leverage. He raised the concern that retail enthusiasm is once again peaking at the exact moment institutional investors are preparing to quietly distribute their shares and exit the market. Lee countered Kernan's bearish narrative by pointing directly to the unprecedented amount of cash currently parked on the sidelines. At the time of this discussion, money market funds held over $6 trillion in assets, largely driven by investors happy to collect a risk-free 5% yield while waiting for clarity on the macro environment. Lee argued to Kernan that this is the absolute antithesis of a speculative bubble. In a true market top, cash reserves are completely exhausted, as retail and institutional players alike leverage themselves to the hilt to chase performance. Having a mountain of capital sitting in cash equivalents means there is a massive structural cushion underneath the market. If equities suffer a meaningful correction, Lee insisted that this sidelined capital will view the dip as an attractive entry point, creating a natural floor for stock prices. I want to unpack this money market argument because it is one of the most frequently cited bullish catalysts on Wall Street, and it deserves a highly critical look. The common assumption is that this $6 trillion represents a giant pile of dry powder that will eventually flood back into the stock market and drive equity prices to the moon. But where I land on this is that we must look at who actually owns that cash. A very large portion of those money market assets belongs to corporate treasuries, pension funds, and institutional managers who use these vehicles for short-term liquidity, operational cash flow, and regulatory capital requirements. This money is not speculative investment capital waiting for a green light to buy tech stocks. It is working capital. Furthermore, for high net worth individuals, a 5% risk-free return is a highly competitive hurdle rate. Why would an investor risk capital in an equity market trading at record valuations when they can lock in a guaranteed return that comfortably beats inflation? What I would watch is the yield curve and the Fed's rate path. If the central bank does begin a sustained rate-cutting cycle and those money market yields drop down toward 3%, that is the specific catalyst that will force yield-hungry capital out of cash and back into risk assets. Until that yield spread narrows significantly, a large portion of that cash is going to stay exactly where it is. As the discussion entered its final segment, Becky Quick brought the conversation back to the ultimate metric of Lee's optimism: his bold year-end target of 6,600 for the S&P 500. She asked him to define the exact boundaries of his thesis, pressing him on what specific variables could prove him wrong and trigger a major market decline. Lee was refreshingly candid in his response to Quick, stating that the primary risk to his bullish outlook is not a standard economic slowdown, but rather an unexpected external shock or a major policy mistake. He pointed to geopolitical instability in Eastern Europe and the Middle East as constant wildcards that could disrupt global energy supplies or throw a wrench into international trade. He also highlighted the risk of a policy error by the Federal Reserve, warning quick that if the central bank remains too restrictive for too long, they run the risk of breaking something in the credit markets, leading to a sudden liquidity crunch. But barring those external shocks, Lee remained firm that the underlying corporate earnings momentum is strong enough to carry the market to his target. Setting a target of 6,600 is an incredibly bold call, but when you break down the mathematical components, it is not entirely outside the realm of possibility. If S&P 500 earnings grow at a double-digit rate over the next year, and the forward price-to-earnings multiple simply remains steady, the index can achieve that level on fundamentals alone. But what strikes me about this outlook is the complete lack of margin for error. When a market is trading at 20 times forward earnings, every single variable must align perfectly. If we see even a minor deceleration in corporate earnings growth, or if a major technology giant misses its quarterly guidance by a fraction of a percent, the multiple compression will be swift and severe. This is the core tension of the current market environment. We are priced for absolute perfection, and while perfection is certainly possible when supported by structural productivity and massive liquidity, it leaves investors highly vulnerable to any unexpected macro curveballs. To look even deeper into the structural shift that Lee and the Squawk Box hosts were debating, we have to analyze how capital allocation has fundamentally changed over the last decade. The hosts and Lee touched briefly on the mechanical nature of the current market, but we need to unpack how the rise of passive investing has created a mechanical bid for a small group of mega-cap companies, creating a momentum loop that operates largely independent of traditional valuation metrics. This mechanical bid is incredibly powerful during a bull market, but it also creates a hidden structural fragility. If we ever see a sustained period of passive outflows, the forced selling of these highly concentrated positions could trigger a downside move that is just as aggressive as the rise. Furthermore, we cannot ignore the physical supply chain risks associated with the artificial intelligence boom, a reality that Sorkin and Lee touched on during their exchange. While the market is pricing in limitless growth for advanced silicon, the physical manufacturing of these chips is concentrated in a single geographic location. Nearly 90% of the world's leading-edge logic chips are produced by a single company on a highly contested island. Any disruption to that supply chain would instantly halt the global technology sector and send shockwaves through the entire financial system. While there is a massive bipartisan effort to onshore semiconductor manufacturing, building these advanced fabrication facilities takes years and requires replicating an incredibly complex ecosystem of suppliers and highly specialized labor. Until that infrastructure is fully operational, the global economy remains exposed to a single point of failure that no amount of corporate cash flow can fully mitigate. Another critical driver of this market that did not receive enough attention during the live discussion is the sheer scale of corporate share repurchases. The largest technology companies are using their massive cash reserves to buy back their own stock at an unprecedented rate, acting as a constant price-insensitive buyer in the market. This corporate buyback activity provides a powerful structural floor for stock prices and artificially boosts earnings per share metrics, even when top-line revenue growth begins to slow down. Investors must look closely at organic revenue growth to determine if these businesses are genuinely expanding their market share, or if they are simply using highly sophisticated financial engineering to maintain the appearance of growth to satisfy Wall Street's expectations. Ultimately, the debate between structural bulls like Tom Lee and valuation-conscious hosts like Joe Kernan comes down to your time horizon and your tolerance for volatility. If you believe we are in the early stages of a profound technological revolution that will fundamentally reshape global productivity, then current valuations are simply a temporary speed bump on a much longer upward trajectory. But if you believe that human nature and market cycles have not been repealed, then the extreme concentration, high valuations, and geopolitical vulnerabilities are clear warning signs that we are reaching a mature and highly sensitive phase of this bull market. Navigating this environment requires a disciplined approach that balances the excitement of structural change with a realistic appreciation of macro risks. Moving forward, the key will be to monitor corporate earnings resilience, watch the Federal Reserve's policy shifts, and pay close attention to whether the massive capital investments in technology are genuinely translating into higher corporate productivity across the broader economy. Thanks for watching. Like the video, subscribe to the channel, and tell me in the comments what I missed. See you next time.